Stuart Thomson is International Fixed Income Fund Manager at Ignis Asset Management. Well, they manage £28 billion of government debt, and he joins us now live from Edinburgh. Stuart, thank you so much for joining us. Now, there has been so much concern that we're going to get a vote, we won't get a vote, and now actually it seems to be thrown up in the air a little bit. Are you confident that we will at least get a debt ceiling agreement by the end of tomorrow?
We're very hopeful. This is the least they could have done, and providing the House and the Tea Party candidates don't want to take blame for this, which we don't think they will, then they will have it passed.
And Stuart, what does it mean for the credit rating? Because we've been talking about it over the last couple of days. Even if they do find an agreement by tomorrow, it doesn't mean that the US can hold on to its AAA credit rating. If it loses that, would it be a disaster in terms of Treasuries?
I think America holds on to its AAA credit rating by its fingernails. I think the rating agencies will give a grudging acceptance, but they won't completely reaffirm it. I think what they'll do is leave America on negative watch, but holding on, as I say, by its fingernails to this AAA rating.
But so you do think that they will stick to the AAA rating. If it doesn't stick, if it doesn't keep the AAA and it gets a AA, will you have to sell some Treasuries?
No, not at all. Treasuries are the most liquid and most credible government bond in the world, and that's not going to change because they don't raise an artificial debt ceiling. Where we do think the problems would arise is in those instruments that are gaining their credibility from Treasuries, the agencies and the municipal government bond markets. But
Stuart,
Treasuries remain safe.
We understand that actually in certain companies and certain funds or certain asset managers have a rule that actually they can only hold on to a certain percentage of government bonds that are not AAA credit rated. So my question is, will it have a repercussion just because certain funds will have to sell them because they can't keep so many and they'll have to buy something which is considered safer by the markets?
Well, there is not enough AAA rated government bonds in the world to meet the demand for international regulations, international investors. So from that perspective, if they switch out of Treasuries, there's only a limited pool of assets which are liquid enough to absorb them. Mm-hmm. And obviously those other AAA rated government bonds would perform exceptionally well. If those investors who are unable to hold Treasuries because they're no longer AAA are forced sellers, then we believe there will be willing buyers of Treasuries because the environment is Goldilocks for the Treasury market at the moment. Growth is neither too fast nor too weak. The Fed is on hold. There's no opportunity to do QE because of the high level of headline inflation. Yeah. So it is a great environment for Treasuries.
But how concerned are you overall that once we get either no vote tonight or we get a downgrade, then actually equities are going to collapse? How nervous are you about the situation right now across all asset classes?
Well, indeed, if there is no vote tonight, if there is a downgrade, then we believe that that will be a risk-off day, and that will necessarily lead to increased demand for Treasuries and the dollar. Perversely, it will be good for those markets.
And so what would what would your number one piece of advice for investors would be ahead of a possible downgrade and ahead of this vote?
Well, I think the market should be cautious. I think the market should focus on the economic fundamentals rather than artificial debt ceilings or indeed the ratings actions of the agencies. We don't think this is going to be a downgrade. We do think there's going to be passage. It could end up being 2011's Y2K. But more importantly, the fundamentals are very favourable at the present time for government bonds globally, but Treasuries in particular.
And in terms of Treasuries, you want to be at the 10-year. You don't want to be at the 2-year, do you?
No, we want to be further out the curve in the longer-dated forward interest rates.